Hi Ashish, good morning.
Hi Mithun, good morning.
We can start the session because the recording has already started.
Okay, so let me just share my screen.
So,
So good morning, students. We are here for the purpose of revision of management accounting, which is a third paper of your ACCA course. So what are we going to do today? Let me just what management accounting is actually all about. So management accounting basically helps you to know gain knowledge and understanding of how management accounting techniques support the planning, controlling, and the of monitoring of the business performance, which will help the management of the organization in taking decisions. If you remember, when we were doing the revision for the financial accounting, we saw that the financial information of the organization is used by the management also. Management use that information for the purpose of taking decisions for running the business for a long period of time. What does management accounting topics include in these labels? They include what is the nature, source, and purpose of the management information. What are the different cost accounting techniques, whether it's a variable costing, marginal costing, absorption costing. What are the different cost type of costing techniques which are there? The third part, once we know what are the cost techniques, we should always focus on preparing the budgets. What are the budgets? Budgets are something that we prepare in the current time for the future so that we actually know what are the levels that we have to achieve in future. Through budgets, we can set targets for us that this is the amount of revenue that the companies about have to achieve their entire budget for the year. And once we have budget aligned with the organization, we in the future we can also use the budget as a measure to observe the performance of the organization. We can compare how much we have actually done and what was the budgeted revenue that we were planning to achieve. Budgeting also helps me to compare my current performance along with the past performance, also along with the budget that I've prepared for myself. So once I have budget ready, I said budget helps me to compare my current performance with the budget that I have assigned for myself, which comes under the standard costing. So under standard costing, what we see that standard costing, what are the budgets that we have prepared and where are what are we actually. Standard costing help us to eliminate between the reasons if we are not able to achieve the target. The reasons can be the favorable or the reasons can be the adverse. If the reasons are favorable, then that's a good opportunity for the company, or it also shows that the company was not able to judge itself properly, and that was the reason the company is overachieving the targets that it was assigned for him itself. If the company is not able to achieve the targets, it will give an adverse result to me, which will show that whatever the budgets that I have planned for myself, I'm not able to achieve even the budgets. It will also help me to identify the reasons for the same.
Ashish, sorry
Then
to
come,
interrupt you. Could you please
yes,
zoom the screen because it's not visible?
is it now, Mithun?
Yes, thank you so much.
Yes. So the next, after standard costing and variance analysis, what is the next topic that is there in this part? It's a performance measurement. What performance measurement? It gives me the key indicators basis which we can assign which will include your cost and buy decision, make or buy decision, whether you should make the product by yourself or you should buy it from outside. What going to be the most benefit for you? Or you should get it made, making of the product internally, or you can send the product to someone else for the manufacturing. These performance indicators help me to uh, break between whether we should buy the product by ourselves or whether we should make the product internally in our organization itself, or if we are making the product, what is the amount of cost that will be involved if I make the product or if I get that manufactured from somewhere else. What is this exam structure for this paper? So the paper is divided into two parts, section A and section B. Section A has 35 objective, which is also called as multiple choice questions or maybe a short answer style questions, which will be of 70 marks. Section B has three multitask questions, typically of 10 marks each. What are the multitask type of questions that something which may arise in your mind? So multitask questions is nothing but they will give you one full question which will have different tasks which you have to solve. Some the most important type of questions which the management accounting usually ask is about they you have to interpret the results, you have to comment on the results that you are achieving, and those are the main type of questions which are there in the multitask questions. Now let's come on the first topic. What is the nature, source, and the purpose of the management information? Management accounting, we all know that it's for the internal users because it helps the top management of the organization. Who are those top management? Your management starts with CEO. CEO assigns a budget that say suppose company has to achieve a growth of 10%. Now, to achieve that growth of 10%, what CEO will do? CEO will assign different options to different departments. So we have say sales department, we have say operations, we have say finance, we have say HR, and we have say other departments. The major growth which will come from when I'll make the sales. So the CEO will say suppose sales department you have to achieve a sales of say 20 lakh rupees, which was 18 lakhs in the previous year. So the CEO will ask the on the basis of the previous information that the CEO has that sales department I need a growth of 10%. So you have to make a sales of 20 lakhs this year. To make a sales of 20 lakhs, what CEO will do? CEO will ask the operations team that last year the production was 1 lakh 80,000 units. This time to achieve the sales of 20 lakhs, I need a sale of 2 lakh units. What operations will do in that case then? Once operation have got the budget for itself, what operation will do? Operation will have a word with the finance that previously to make 1 lakh 80,000, I was requiring 1 lakh rupees. Now to manufacture 2 lakh unit, I will need 1 lakh 20,000 rupees. So in this manner, the budget that the growth that was decided by the CEO will get further divided on the basis of the different departments. What the different departments do? Basis that the roles will be get divided between the departments. And on what basis the CEO decides this? The CEO decides this in all these budgets, all the growths, basis the financial information, the previous financial information that the management has. So the management accounting is for the internal users. They use the information of the past to decide or to take the decisions for the future. It, the this management information supports the decision making. So we see over here that management has decided basis the past information that where they were achieving a sales of 18 lakhs, they want to achieve the sales of 20 lakhs. It also helps in planning. So we saw over here that since the sales department needs to achieve the sales of 20 lakhs, they decided and they planned accordingly with the operations department that where we were actually manufacturing 1,80,000 units, this month we have to manufacture 2 lakh units so that we will be able to achieve the sales target of 20 lakhs. Then operations had a discussion with the finance that where we required 1 lakh rupees for manufacturing of the 1,80,000. This year we'll be requiring 1,20,000 for achieving the budget for achieving the production of 2 lakh units. It also keeps a control. So each department will be accountable for the budgets that have been assigned to them. Finance department will see that it does not release more than 1,20,000 rupees to the operations department for buying the extra inventories. In performance evaluation, now once the budgets have been assigned, now when the year will come when the sales department will actually making the sales in the market, we will be able to see on that particular information whether the sales department is actually achieving the targets of 20 lakhs or not. What are the revenue that the company is actually achieving? Say suppose the company achieved 20 lakhs as a revenue. That means sales department has achieved the targets which were given to them. Now, whether the 20 lakhs has been come from 2 lakh units which was manufactured by the operations, or the operations has manufactured more number of units, or the operations has manufactured less number of units, but because of the efforts of the sales target team, they are able to achieve the revenue of 20 lakhs or not, or whether the operations were able to achieve this 2 lakh units, but finance department has released the actual budget of 1,20,000, or they've uh, provided a less budget, or they have provided a more budget in helping the operations department in achieving those targets. So on the information what has actually happened versus what was asked for is help me in evaluating the performances. What are the qualitative features of the good management information? Its relevance. So as we see in yesterday also, what do you mean by relevance? Relevance means information should be accurate. They should provide what has actually happened. Timeliness. Let me just erase this information. The management information should be timely available so that the management will be able to take the decision. Say suppose I want to achieve a target of 20% for the next year, or say 10% for the next year. On what basis I will take this decision? I will take this decision basis the information that I have on the current year. If say suppose my next future year has started, but if I don't have the information for the past year, how will I assign the roles or the objectives that the company wants to achieve to the departments? I will not be able to. So the management information basis which the company has to take the decision should be timely available with the management. Accurate information. The information which is available with the management should be accurate. Say management, the company has done, and in my example, the company has done a revenue of 18 lakhs in the previous year, and the company targets to achieve the 10% growth for future. See, if the information would have been available with me that the company has achieved only 17 lakhs instead of 18 lakhs, what I have forecasted for the next year is the company will be able to achieve only 19.7 lakhs, or I would say 18.7 lakhs, which is a wrong budget for me because I don't have the accurate information available with me. The actual information was 18 lakhs, but since the accurate information was not available to me, what I have is was 17 lakhs, and I was actually under. forecasting myself that I'll be able to just achieve 18.7 where I could have achieved at least 20 lakh rupees. The complete information should be available. So as we see, I need complete information and not just the half information what is something that I have to achieve. Understandable. The information that is available with the management. The management should be able to understand that information properly. The information should not be in a form which is difficult to understand for the management. So suppose I have to manufacture say product A and I have two options available with me. That is to make the product or to buy the product. Say suppose if I buy the product, it will cost me 15 rupees per unit. But to make the product, I have information that uh, the raw material that I will purchase will be available at 10 rupees per kg. But I don't have the proper information about or it's given somewhere. Let me just 1 second. Let me just provide you with an example properly for this thing. So say suppose I have to manufacture product A. I have two options available to me. Either to buy the product at rupees 15 per unit or to make the product say make for making the product I say it will require 10 rupees per unit of raw material and an information is given that the labor will be available for say 15 hours at XX amount per unit, XX amount. Now tell me, are you able to understand anything from the XX amount? No, right? Because it since it's not providing me the correct numbers, it's not providing me with the correct information. X is something which the management will not be able to understand. What management will require, what is the actual amount that will be required, whether it's 5 rupees per unit or 2 rupees per unit or whatever. On that basis, the management will be able to take information or to take decision whether along with 10 plus 2 that comes out to 12 whether the management should make the product internally or whether they should get buy the product from outside. The XX amount or compensation in some other manner is something which the management will not be able to understand, which will create ambiguity for the management to take the decisions for the future. Cost benefit trade off. So as I previously shown in the previous example that the management has two options, either to buy the product at rupees 15 per unit or to manufacture the product internally at 12 rupees per unit. Which is the more beneficial for the management, to buy at 15 or to make it 12? So obviously to make it 12 is the more benefit. So what management will do, management will internally manufacture this product, which will provide me a benefit of three benefit of rupees 3 per unit. What are the informations that the management use? They use the historical and past information. So, as I said in my example, that the managed company was achieving a target revenue of 18 lakhs. Now the company wants to grow. So basically 18 lakhs of the information, which is the past information. Now management is planning to achieve more 10%, which is 20 lakhs in the future. So they've used the past information to set the target for the next year. They use the current information, what the company is actually doing versus what the budget company is actually forecasted to achieve, to analyze the budgets, forecast, and the projected information. Now, when the sales department has got the budget that they have to achieve a revenue of 20 lakh rupees. So they forecasted with the operations team like to achieve the revenue of 20 lakhs. What was the number of units that they want to manufacture? So they forecasted that to sell the 20 lakh units, they have to achieve the budget of 18. They have to targets of 20 lakh rupees. They have to manufacture 2 lakh units. So they forecasted how much additional units they will be required. The operations team will be required to manufacture. What are the constraints? The data availability. So as we saw in the previous example that the management was not having proper information about the labor cost. What was the labor that will be chargeable for me, whether it's 2 rupees per unit or 5 rupees per unit. So it's a constraint for the management that sometimes the complete information is not available with the management. Then there comes a problem of subjectivity. Sales department, in the example that we took, that the company has to achieve the revenue of 20 lakhs, there can be a question or constraint of subjectivity. Subjectivity in what manner? The sales department may say that we have to achieve the target of 20 lakhs. To achieve the target of 20 lakhs, or what or some sales team will say, to achieve the target of 20 lakhs, start manufacturing more number of units to achieve the target. But what finance team will come and say? Let's manufacture just 1,80,000 units and increase the price of the product so that with the same number of units, the company may able to achieve more targets. But the sales team will be constrained with the fact that instead of increasing the price, let's increase the number of units so that the customer will be able to buy the same particular product at the same price at which they are buying currently. But the finance team will be of the opinion, let's sell the same units with the increased price so that the company will be able to make more profit out of it. There comes a problem of subjectivity between the two departments. Because of the subjectivity, there can be a delays in the operations, there can be delays in the actual achieving of the revenue. Now let's understand this with the help of an example. So a management is considering introducing a new product line. Okay. To decide whether to decide they might need, if the management has to introduce a new product line, what do they need? They need a forecasted cost. What was the cost that will be required for starting a new product line? What is the projected revenue? So whatever the, if they are setting up new product line, what's the expected revenue that the organization can earn from this particular product? And what is the incremental profit? Say suppose company was till now manufacturing just product A. Company decides to focus, let's start also making product B and sell it in the market. To make the product B, what the company will need? The company will see what are the market opportunities available for this particular product. On that market opportunities, the company will decide what is the expected revenue that the company can generate from this particular product. When the company has decided that this is the particular expected revenue that the company can generate from this product, now the company will see what is the expected cost that will be required to manufacture this particular product. Expected cost just means when the company is actually seeing what is the expected cost, the company will also see not just the variable cost that will be required for this particular product, they will also see is there any additional fixed cost that is involved. So when I say fixed cost, variable cost means only the part, only the production or the raw material or the labor cost will be involved. But when I say fixed cost, do the company need to invest on the machines for the manufacturing of the product? Or do the company need to set up any extra factory for the manufacturing of the product? These are the hidden actual fixed costs that are involved if we are buying, we are starting up with a new product line. These are the different costs which will be involved. The will make a factor of all these things. Basis the expected revenue that the company plans to achieve and the expected cost that will be involved. The company see what are the incremental revenues, incremental profit that the company is able to achieve. If the company feels that they were able to achieve an incremental profit out of this new product line, they may decide to open a new product line and to have and to decide whether to go for this particular product or not. The company must have the all the data. What is data that is about expected revenue, expected cost, readily available with them timely. Exclude sunk cost. All the relevant information must be available. That includes sunk cost. Sunk cost, when I say if the company already has a manufacturing plant, then it's not, and in the same particular plant, the production can be done. Then the cost that will be involved to set up a factory will not be required. So company don't have to consider the factory cost. In that case, the only relevant information with the company will be what's the expected revenue and what's the expected cost of manufacturing that product. And the information should be understandable to the non-financial managers. So what the expected revenue that the company is generating, what the expected cost that will be required should be understandable to the non-financial managers. So when I say non-financial managers, should be understandable to the sales team, to the sales manager, to the operations manager, so that they will be able to understand what is the cost, what is the information that the company is actually talking about. What are the number of units that the operations team had to manufacture? What are the number of units that the sales team has to sell in the market to achieve the incremental profit? Now, let's move on to the cost accounting techniques. First of all, this cost accounting technique is a huge part of the syllabus. Majorly questions comes from this particular portion. So what does it involve? It involves classifying the cost, whether it's a fixed cost, it's a variable cost, it's a semi-variable cost, or it's a direct cost or indirect cost, or whether hmm, understanding its behavior and determining the cost under different methods. Now, first look at what are the cost, different type of cost which are there. So there are four, or I would say six different type of costs. That is fixed cost, your variable cost, your semi-variable cost, your direct cost, or your indirect cost. What are the fixed cost? The fixed cost are the one that does not change, or which I would say which remains constant. So let me just take an example. In the previous example we discussed, if the company wants to set up a new product line, they may require to set up a factory, or they may take a factory on rent where the manufacturing of the product will be done. Irrespective, so if I take the factory on rent, irrespective of whether the actual product is getting manufactured or not, since I have taken the factory on rent, rent is something that I have to pay always. So rent remains my fixed cost. It does not keeps on changing. This is the number of units that I'm manufacturing. So if I say example, take a rent building on rent for manufacturing of a product for rupees 1 lakh rupees. Whether I'm manufacturing the product or not, I have to pay 1 lakh rupees every time to the owner, every month to the owner. So which turns out to be my fixed cost in the business, which means irrespective of whether the operations are actually happening or not, fixed cost is something that I have to bear it out. the variable cost. Variable cost changes in direct proportion to the activity. So we understood that fixed cost will always be there irrespective of whether manufacturing is happening or not. Now, what's variable cost? Variable cost means it will be incurred if we are manufacturing the product. So, to manufacture a product, say I will need 1 kg of raw material. For manufacturing 10,000 units, or not like, let me not just take this thing. So, let me just give you an example. Manufacturing one product cost me, say in total, rupees 15. So, if I make just one product, my cost would be rupees 15. Say if I make 100 units, my cost would be rupees 1500. So I wanted to explain over here that the variable cost keep on changing with the increase in the number of units. The variable cost keep on increasing with the increase in the number of units because variable costs are subject to the number of units that I'm manufacturing. So if I manufacture just one unit, I will incur only 15 rupees. If I manufacture 100 units, I will incur 1500 rupees. So the variable cost change is in proportion to the activity. If I'm increasing of one unit, I'm increasing the cost for that unit. Now, let's move on to the semi-variable cost. Semi-variable cost is nothing but a combination of a fixed proportion plus a variable proportion. The example can be electricity or the example can be labor. So, how labor can be an example for the semi-variable cost? So, let's say for an example, my labor chart says that irrespective of whether the manufacturing has been happening or not, I have to pay rupees 600 per day to the labor, irrespective of the manufacturing. And plus, if the manufacturing is happening, they will charge rupees 5 per unit. So, when the actually manufacturing is happening, and say, suppose if I manufacture 10 units, if I manufacture 10 units, what is the cost that I'm going to bear? So let's take three examples. If the company manufactures 0 units, if the company manufacture 1 unit, or if the company manufacture 10 units. So if the company is manufacturing 0 units, the company has to pay labor of rupees 600 because irrespective of any production happening or not happening, the company has to pay labor as 600 for that particular day. If say the company manufacture 1 unit, the company has to pay rupees 600 plus rupees 5. That is 605. The company has to make the payment rupees 600 plus 5. 605 rupees the company has to pay to the labor for that particular 1 unit of production. If the company is manufacturing 10 units, the company has to pay 600 rupees plus rupees 50. That is 650 rupees the company has to pay to the labor. So in this particular example, we understood that even though the company is manufacturing or not manufacturing anything, the company has to pay 600 irrespective of the production or not. But the company can save, but the company is saving on the per unit cost. So the 600 becomes my fixed cost and the 5 rupees per unit becomes some variable cost. When there is a combination of these two costs involved in one particular production, it turns out to be a semi-variable cost. Now let's move on. What is the step cost? Step cost is nothing but which is a fix for a range and then jump to a new level. So we can understand it in this manner. Say if I manufacture or if I buy, let's take an example of buying in this case. So I want to particular purchase say 20 units of product A. I went to a supplier of product A. What the supplier says to me that if you buy 1 unit to 10 units, you will be charged rupees 15 per unit. If you buy in between of 10 to 15 units, you will be charged rupees 12 per unit. If you buy between 15 to 20 units, you will be charged rupees 10 per unit. So, in this example, we can say that if we are buying in between 10 to 15 units, we will be paying rupees 15 per units. But if we increase our demand from 10, in between 10 to 15 units, we'll just have to pay 12. So I'm saving rupees 3 per unit over here. And if I'm manufacturing 20, if I'm purchasing 20 units in between 15 to 20 units, then I just have to pay 15 per unit. So as I changes to a different level, I changed from 10 to 15. I saved on cost of 3 rupees per unit. If I jump from 15 to 20, I'm saving in between extra for the 2 rupees. So step fixed cost is nothing. Assets remain fixed for a range. That is over here. Rupees 15 is fixed for a range of 1 to 10. Rupees 12 is fixed for a year of 10 to 15. Rupees 10 is fixed for a range of 15 to 20. As I'm jumping off from one range to another, I'm keep on saving on the cost. So step cost is nothing but which is a fixed over a range, and then if we start jumping to a new level, we keep on getting a new cost involved for that. Now then comes a new costing, that is direct cost, which is traceable to a cost object versus indirect cost, which cannot be traced directly. Those are the overheads. So if we are manufacturing, when we saw the example of manufacturing the product, we saw that irrespective of whether we are manufacturing the product or not, we have to bear the cost of factory rent, which is an indirect cost. Because when I'll be d- creating a selling price of my product, when I'll be making a selling price of my product, I will consider all the costs that are relevant for that are important for me. Because see, we need to understand that the business earns a profit. What the profit is all about? Profit is after all the expenses what the company has incurred. Or after all the expenses that the company has incurred, whether directly or indirectly. after the sales becomes my profit. Sales is something which is a direct revenue for me. In expenses, there can be a direct cost, that is the cost of manufacturing the product. So if I'm manufacturing that, I'm incurring those costs. Those are the direct costs. But what are the indirect costs? Indirect costs, for an example, let's say rent, irrespective of whether the company is there or not, irrespective of whether the company is manufacturing the product or not, the company has to bear the expenses of rent. So rent become my indirect cost. So if to earn the profit, I need to eliminate the indirect cost also. So indirect cost is something that cannot be traced even at the unit level. When I say traceable, traceable means at the unit level it cannot be traced. Direct cost is something that is traceable. If we are manufacturing the product, we are incurring 15 rupees for the manufacturing of that particular product. That is the direct cost, which can be easily traceable alongside the product. Now, let's move on. What are the cost behaviors and the cost functions? You may see that the costs are frequently expressed as high to low method or regression, or the estimate fixed and variable components in a mixed cost basis. Now, let's move on to the different type of costing, that is the absorption costing or the variable costing. When I say absorption costing comes in the case of the indirect cost, the cost which cannot be traceable for at the allocated unit. So what we do is, so for example, we talk about rent. The company is incurring a rent of say 1 lakh rupees, and the company is manufacturing 10,000 units. So what will happen is 1 lakh rupees will get divided in 10,000 units. So for each unit, I will have 10 rupees allocated for the rent. So what the absorption costing says, fixed production overhead. What is fixed production overhead in our example? It's rent allocated to the units. How much number of units that I'm manufacturing? 10,000 units. So my rent of rupees 1 lakh gets allocated between 10,000 units, which is also called as absorbed. What we call this particular absorption, what we call this particular uh, 10 rupees per unit of rent, we call it as absorption, because the 10 rupees is getting involved in the particular product for setting up the selling price of that particular product for the market. So in included, and this gets included in the inventory cost, as I said. So I know that if I have to manufacture a particular product, I will involve a 15 rupees of variable cost. And along with that, I will involve 10 rupees as my absorbed cost. Absorbed cost is nothing but the rent that I'm paying of 1 lakh rupees gets divided by the number of units that I'm manufacturing. Say that this comes out to be in total 25. So if the company wants to say earn a profit of 20% over the cost, what 20% means that the company wants to earn extra 5 rupees as profit. So the selling price of the product will be 30. When the company will be actually selling the product at 30, now let's see in actual how the profit and loss will look like. Say the company is selling the product at 30. How much units the company is manufacturing? Company is manufacturing 30,000 units, 10,000 units. So the company will make a revenue of 3 lakh rupees. What is the direct cost that is involved? Say it's at 15 rupees variable cost. So the direct cost would be around 1,50,000 rupees. And the company is actually incurring an expense of 1 lakh rupees as rent. So the profit that the company is making turns out to be 50,000. That is 20% of the cost that I am incurring. My total cost is 2,50,000. 20% of the cost is my profit. So if, say, for this example, the company instead of 10,000 units would have manufactured 9,000 units, or let's say not 9,000, the company would have manufactured 5,000 units. 5,000 units. then in this case, my absorption cost would have been 20 because my rent remains the same. Rent is a fixed cost which remains the same. My absorption costing would have changed to 20 rupees because now I'm just manufacturing 5,000. So the total cost of rent will get divided only in 5,000 units. So which will give me an absorption cost of 20 rupees. So over here, if I'm my total cost that will be there in this particular case is going to be 35 rupees. Total cost in this case is going to be 35 rupees. So if I want a 20% profit, my profit element is going to be 7 rupees in this case. So over here, my total selling price for this particular product is going to be 42 rupees, where I was actually selling the product at 30 rupees. Now I have to increase the price to 42 rupees. Now, what is variable costing? Variable costing is nothing. Only variable production cost go into the cost of units. We know that fixed overheads, that is the rent, is a period cost, irrespective of manufacturing happening or not. We have to pay the rent cost because it's a fixed overhead. Variable costing means the costing which is incurred only if the production happens. So the material cost will be involved if we are actually particularly manufacturing the product. If we are not manufacturing the product, we will not incur any material cost. So variable costing is nothing but the cost which is involved, which is incurred only if the production is actually happening. Now let's talk about the very common terms in the costing, that is the contribution. What is the contribution? Contribution from a product, or we contribution of from a product. When I say contribution from a product, what is the incremental revenue that the product will provide to me? So suppose say I was manufacturing 100 units. My selling price, say for example, 30 rupees. And the cost of manufacturing the product, I would say rupees 20. If I decide to manufacture 105 units, I was already in, and the company has to take this decision. So let's take a proper example in this case. The company has product A. Till now, company is paying a rent, say rupees 1,000, manufacturing 100 units. Total cost involve 10 rupees as my variable cost and 10 rupees as my absorption cost, which gives me a total cost of 20 rupees as my total cost. The selling price of my product, say rupees 30. If the company decides that the company wants to increase the number of units to say by, let's say by 10 units, the company, instead of manufacturing 100 units, the company let's decide to manufacture 110 units. Now in this case, for 10 units my selling price would remain the same, that is 30. On what basis I will take this decision? I will take this decision on the basis irrespective of the 1 lakh cost, which or the 1,000 cost, which was there in even when I was manufacturing 100 cost rupees, 100 units, this 1,000 cost will remain the same. The only factor that will come into picture is the variable cost. So I will see what is the contribution that the company is making by making an additional 10 units. So the company is actually making 20 rupees per unit contribution because 1,000 is already getting absorbed under the 10 rupees part, under the 100 units which we are already manufacturing. So by manufacturing additional 10 units, I'm not incurring any extra rent. So if we try, if we decide to manufacture additional 10 units, we will make 20 per unit additional contribution. So contribution is nothing but the additional sales revenue and the variable minus the variable cost. How we calculate the contribution margin ratio? The contribution margin ratio is calculated on the basis of contribution upon the sales. So in this example, it's going to be rupees 20, the contribution upon rupees 30, the selling price. What is the break even point? Break even point is nothing but the contribution per unit. So let's take an example for this. Let's take an example for the break even point. And what do you mean by break even? For me, I'm selling the product at rupees say 30. The variable cost of my product is say rupees 20. So what's my contribution? My contribution by selling by making one particular product is rupees 10. That is 30 minus 20. Now I know that I have a fixed cost of rupees 1 lakh. I have a fixed cost of say rupees 1 lakh rupees. Then in that case, what is the break even point? Break even point means what are the minimum number of units that the company is required to manufacture or to purchase or required to sell to achieve at least zero profit. That means that is, if I sell, if I sell less than break even point units, the company will be under loss. If I sell more than break even units, the company will be in profit. So I have a fixed cost of, say, example of rupees 10 lakhs, and my contribution is 10 rupees per unit. In this case, the company need to have at least 10,000 units to be at the break-even point. Because if The company is manufacturing 10,000 units. Its contribution will come out to be 1 lakh rupees. And what is the fixed cost that the company has? The company has a fixed cost of say rupees 1 lakh. What's the profit that the company is making? The company is making a profit of rupees 0. If the company is manufacturing, say, suppose 9,000 units, what is the total contribution that the company is making out of over here? The company is making a contribution of say total 90,000 rupees, but the company's fixed cost is less than 10 is rupees 1 lakh. Then in this case, the company will be in loss. So suppose now in if the company is manufacturing 1 lakh 10,000 units, uh, or let's say 11,000 units, the company will be making a total contribution of 1 lakh 10,000, and the company has a fixed cost of say 10,000. So additional 10,000 is my profit. So we can understand it in this manner that with any incremental unit over the break even point will give me a profit. With any unit less than my break even point will give me a loss. To at least be at a break even point, I need to at least at a zero profit, I need to achieve at least a break even unit of production. So how the break even point is calculated? Break even point is calculated by the formula of fixed cost upon the contribution that the company is making at per unit level. This will give me the number of break-even units that are required to achieve at least a zero profit. Margin of safety. Margin of safety is nothing but at least some profit in hand, or I would say, what is the actual sales minus the break-even sales. My actual sales was, say, suppose 11,000 units, and my break-even sales was 10,000 units. So in this case, my margin of safety is of 1,000 units. Now let's see this example. The company has a selling price of say rupees 100. The variable cost of the company is say rupees 60, and the company has a fixed cost of rupees 2 lakhs. Now we need to calculate the contribution per unit. So we know the formula of contribution per unit. Since our selling price is 100, our variable cost is 60, our contribution is going to be rupees 50, 40. So the contribution per is going to be rupees 40. Now to calculate the break-even units, break-even units is nothing but 20,000 is my fixed cost upon contribution per unit. This gives me a break-even unit of 500. So in this example, if I manufacture 500 in one unit, I'll be in profit. I'll be in profit. If I manufacture 499 units, I'll be in loss. If so, you can see if they plan to sell 1,000 units, the margin of safety is so if they plan to sell 1,000 units, then the margin of safety is 500 units. That is 1,000 actual or planned sales minus the break-even sales. If the company wants to achieve a target profit of say 10,000 rupees, 10,000, then the required units is gonna be 20,000, which is your fixed cost, plus the 10,000 that we see in a previous example that the company wants to achieve the 20% profit. So our variable cost was rupees 15. Our very hmm, our total cost was rupees 25, and the company wanted to achieve 20% profit. So the 5% was the profit that the company was planning to achieve on per unit. So we decided to keep a selling price at rupees 30. Or the another method of calculating the selling price is we have the total fixed cost that is required, that is 20,000. We know that we need 10,000 rupees as profit. So total amount of revenue that the companies actually wanted to achieve is say, let's say 30,000 rupees. What is my contribution per unit? Let's say 40. So the number of units that I wanted to manufacture is going to be 750 units. Now let's talk about the budget and budgetary controls. Now let's talk about the budgeting and the budgetary controls. What is the purpose of the budget? Purpose of the budget is to set goals, to coordinate between the different parts of the business. So in the first example that we took, the CEO wants a 20% growth. When the CEO wants a 20% growth, they communicated the budget with to the sales department that they have to achieve more 20% revenue this time than compared to the previous month. Sales department coordinated with the operations that they will need more number of units to sell in the market for this particular year to achieve the budgets. Operations team coordinated with the finance team that they will need more investment from the finance side in manufacturing more number of units. Communication. Communication. So the CEO communicated to the sales about the requirement of the company's growth. The sales team communicated with the operations. The operations communicated with the finance. So the proper communication should be there, and the budget should be properly communicated to all the departments so that the- we can hold each department accountable if the company is not able to achieve the defined budget that has been allocated to them. We have to motivate the managers to achieve the targets. Just by giving the targets does not mean the management just will be able to do it. We need to keep on pushing the managers. We need to keep on motivating the managers to achieve the targets that company has set so that the company will be able to achieve the targets that the company is planning to. We need to control or compare with the actuals. Whatever the budget that we have keep, we have to compare the same with the actuals, whether the company is actually able to achieve the budgets that have been aligned or not. What is the if the company is not, then what is the reasons for the same? What is the reason of the company's going on an adverse side, or what is the reason of the company is going on a favorable side? It's always better to go on a favorable side than to go on the adverse side. What are the different types of budgets? So we have an operating budget, which is further divided into sales budget or the production budget or the cost budget. So as we see in an example, the CEO gives a sales budget to the sales department of 20 lakh rupees. The sales department transformed that or converted this to an production budget that instead of 1 lakh 80,000 units, will be requiring 2 lakh units this particular year. The production budget that get further divided into the cost budgets, that is how much the material will be required, how much the labor will be required to achieve the particular production of 2 lakh units. Then comes the cash budget. What is the cash budget that will be required? How much is the cash that will be required to achieve the revenue, or how much is the cash that we are planning to actually achieve in this particular year? We are planning to achieve 20 lakh rupees as cash in this particular year. For achieving that 20 lakh rupees, what are the actual cost cash that will be required in production or in eliminating various different costs? Master budget. Master budget means combination of all the individual budgets. So the sales will have its own budget of achieving say 20 lakh rupees. Production will have its own budget of manufacturing 22 lakh units, which will be supposed in terms of value, say 15 lakh rupees. When we combine all the budget at the company level, so the company level will focus on the profit. So the company level entire budget will get accumulated. So it will be like the revenue of 20 lakh rupees against the cost of 15 lakhs, which will give a 5 lakh rupees profit to me. So when I combine all the budgets of the different departments at one single point at the company level, it gives me one individual budget, which is also called as the master budget. Flexible budgets. Flexible budgets are adjusted at the actual activity level. With each different production or with each new product line, my new budget gets associated with the actual activity. If I'm shifting from product A to product B, if adding product A along with product A, the product B, the budget for product B will be different. So with different activities, my budget keeps on getting adjusted according to it. If I decide to make product C also in future, my budget will adjust accordingly. My budget will have include both the product A, product plus product B plus product C, which gives me under the purview of the flexible budgets. The rolling budgets or the continuous budgets. Rolling budgets or the continuous. See, usually what's the practice that is followed in the organizations are they prepare the budgets in the beginning of the financial year and then they follow the budgets for comparing the positions or for comparing the actuals. But rolling budget or the continuous budgets provide me with the flexibility or keep on updating the budgets over a period of time. That means, say, suppose I decided that I wanted to achieve a revenue of 20 lakh rupees. In between, say in the mid of the financial year, I came to know under a circumstance that I'll be able to achieve not just 20 lakh rupees by increasing the price, I'll be able to achieve the revenue of say 22 lakh rupees. If I'll be able to make achieve a revenue of 22 lakh rupees, I due to the favorable conditions in the economy, then I will shift the budget accordingly from 20 lakh to 22 lakhs. Accordingly, my operation budget and the finance budget will also keep on shifting. Where I was just manufacturing 2 lakh units for this particular year, I will start manufacturing 2 lakh 20,000 units. Where the finance department was giving me a budget of 1 lakh rupees, it will shift to 1 lakh 20,000 rupees for making the additional 20,000 units, which will help me to achieve an incremental budget of 2 lakh. That is from we shifted from 18, we had our revenue of 18 in the previous year. We decided to go for 20 lakhs, but because of the favorable condition, I shifted from 20 to 22 lakhs. This flexibility or this shift is possible only under the rolling or the continuous budgets which are there. Then comes the budget variances. Budget variances is nothing where we actually compare what was the planned budget that we have given. We've given the budget of say 20 lakh rupees to the sales department, and we compare with the actual results whether the sales department is actually able to achieve 20 lakh rupees or not. So let's see this with the help of an example. So in this case, we budgeted that we will sell 1,000 units at rupees 100 each. That means we'll be earning a revenue of say 1 lakh rupees. Now, as I said in the previous example also, this sales revenue will get transformed to the operation budget. Now, the production budget might use that to derive what is the material that will be required, what is the labor that will be incurred, what are the overhead budgets that will be required for achieving a revenue of 1 lakh rupees. See, so if the actual sales of 1100 units have happened, that means I have done a favorable budget over here. Like I planned for selling 1,000 units, but actually ended up selling the 1100 units. And the actual variable cost per unit in this case, if I'm selling at 1100 unit, my variable cost per unit would differ. Now let's understand this particular topic in a proper depth under the standard costing and the variance analysis. What, in simple term, what do you mean by standard costing or the variance analysis? Standard costing or the variance analysis is nothing but comparing the actual results. Standard costing versus variance analysis. Standard costing versus variance analysis is nothing. In simple terms, if we say it's just comparing the current actual results with the budgets that we have allocated. So standard cost is a predetermined cost for a unit. Predetermined means that the budgeted cost used for planning and control So when we are actually budgeting, we actually need to keep in mind that the budgets that we are keeping for us should be actually attainable. Whether the We should not keep an unattainable budget. Which if we keep an unattainable budget, when I say unattainable budget means which is something which I will not be able to achieve anytime in future. We know basically practical problems that we have. We know what are the practical challenges that we face. So whatever the budgets that we are keeping us for the future should be actually achievable, should be actually realizable in terms. Only then we can be easily able to compare what was the budget and what we are actually where we actually are standing. If we keep an unachievable result, we will not we never be able to achieve those targets. In those particular cases, my standard costing will always give me an adverse result because my standard costing will tell me that you budgeted for 1 lakh revenue, but you are just able to achieve 50,000 because 50,000 was the realistic target that I could have achieved. When the actual cost differs from the standards, when the actual cost differs from the standard, the difference is a variance. So when there is a difference between the actual and the budget, there which those particular difference are all is known as variance. The variety of variances are the material variance because the change in the profit of for the organization can be because of the change in the material rates or the quantity. The variance can be on account of labor. The labor rates can be high or low, or the effective hours that we have planned that these number of hours will be required to manufacture the product. The labor may have taken more number of hours or less number of hours. That can be the reason for my variance in the profits or the overhead variance, the volume variance. So I planned for 10,000 units. But I ended up making only 9,000 units, which will affect my absorption costing of at the per unit level. Now, how to calculate the material price variance? So, see, let me just give you an example and how the structure looks like. So, the company decided that the company wants to earn a profit. Now, what can be the reason for the company is not able to achieve its desired profit? The profit can be affected either due to sales or due to cost. Now, what can be the reason in the difference in the sales? It can be in the number of sales quantity, or it can be because of the sales rate, the sales selling price. The variance in profit can be either due to sales quantity because of the sales or the cost. The reason in the sales can be because the number of units that we decided and the actual number of units that we have sold, or is it because of the selling price? So if whether we have decided to sell at 10 rupees per unit and we actually sold at 9 rupees per unit. Now, what are the cost? The reason under the cost can be either due to material, whether the variance is because of the material, or it can be because of the labor, or it can be because of the overheads. Now, what in material? Material can be we decided that we will purchase the raw material at say it can be due to the price, or it can be because of the quantity manufactured. When I say price, the price it will means we decided to purchase the raw material at 10 rupees per unit. But when we actually started producing thing, I got the raw material at 10, 12 rupees per unit. Let's say quantity. What quantity? So I decided to manufacture 10,000 quantity, but I ended up manufacturing only 9,000 or 11,000 quantity. Now, in case of labor, what variance can labor provide to me? The labor variance can come because of either rate that the rate on which I'm paying to my laborers, or it can be because of the effective hours. So we plan that our labor will provide an effective hour of say 8 hours per day, but the labor actually provided me 6 hours a day or 10 hours a day, or the overheads, number of units that I have manufactured. So this is the entire standard costing comparison which we do at the company level for comparing the budgets that I've aligned along with the actual results that I'm achieving. So we saw that the variance can be of different types. What are the formulas for calculating the variances? To calculate the material price variance, what we do is we take the actual price, we subtract the standard price from the same, and we multiply the actual quantity. For material usage variance, the formula is actual quantity minus standard quantity into standard price. For labor wage, it's actual rate minus standard rate into actual hours. For labor efficiency, it's actual hours minus standard hours into standard rate. Now, let me just explain you what this and how this particular formula is arrived. So, for example, say we decided to manufacture 1,000 quantity, and we actually manufactured 1,000 quantity. But we, when we decided to manufacture 1,000 quantity, we decided that we will buy the raw material at say rupees 10 rupees per unit. In that case, my total cost would have been 10 into 1,000, that is 10,000 rupees. But I actually paid rupees 11 in case of raw material. So my variance is of rupees 1 per unit. My actual quantity was 1,000. So my actual variance that is there, or that is an adverse variance for me, is of rupees 1,000, because instead of 10,000 that I would have actually paid, I would have ended up paying 11,000 rupees. So I'm paying more to the supplier. That's an adverse variance for me, which because this additional 1,000 that I paid to the supplier will end up giving less profit to me. If in this example my actual price say would have been 9 rupees, then my price variance would have been given me a favorable results, because I decided that I would be, or I when I budgeted that I would be incurring at 10 rupees for the raw material, but I actually incurred just 9 rupees. So where I was actually planning to incur 10,000 rupees for the material, I will now just pay 9,000 rupees to the supplier. So in that case, I'm giving more 1,000 rupees to my profit variance. So this 1,000 in the previous one example, it was adverse for me. In the current scenario, it's a favorable for me. Now let's see with an example. So say a product uses 2 kgs of material per unit at a standard price of rupees 5 per kg. So this is my quantity and this is my price. I plan to produce 1,000 units. So the standard quantity would be 2,000 kgs, because one unit uses 2 kg. Now, to manufacture the 1,000 units, I would require 2,000 kgs. Standard cost would be 2,000 into 5, that is 10,000 rupees. In actual, what has happened? I manufactured 1,000 units itself, but the actual material that I have used was 2,100 kg. That is 2.1 kg per unit. Instead, which I decided that I will use 2 kgs for manufacturing one unit. And my actual cost was 11,025. So now let's calculate the material price variance. For calculating material price variance, what I need is actual price standard price along with the actual quantity. I have the standard price that is rupees 5. I need the actual price. So actual price is going to be 11,025 upon 2,100. That turns out to be 5.25. So I paid instead of 5 rupees per kg, I paid 5.25 per kg. So my material price variance is going to be. But before going for the calculation of material price variance, just tell me one thing. This 5.25 which I paid for purchasing in actual versus the plan which I have of 5 rupees, the additional 0.25 is a favorable for me or is an adverse for me? It's an adverse for me because I'm paying more to the supplier. It will deteriorate my profit. It will reduce my profit. I paid additional 0.25 over the actual quantity of 2100. So I actually incurred 525 rupees extra for manufacturing the particular product. Now let's calculate the material usage variance. Material usage variance is the actual quantity that I have used. I've used 2100 units against the plan of 2000. So my actual additional cost that I've incurred because of using extra quantity is 500 rupees. When I combine these two, that is 525 and 500, this gives me 1025. This is the actual additional cost that I have incurred against the planned cost. So I planned of incurring a cost of 10,000 rupees, which can be seen over here. But I actually ended up paying 11,025. I have paid 1025 rupees extra. The reason for this 1025 is 525 because of the change in the price from 5 to 5.25, and the 500 because of the change in the usage of the quantity from 20,000 units, 2000 kgs to 2100 kg. Now let's move further. Now let's talk about performance measurement and monitoring. What are the key performance indicators? The key performance indicators can be the financial or the non-financial metrics. That is, what's the sales growth that the company is achieving? What's the production efficiency that the company is providing to me? What are the quality levels? If is I'm providing the quality product of the top level quality, or my product is something which is not up to the levels. What is the customer satisfaction that I'm generating from my selling the product? I can also evaluate the performance based on the ratio analysis. That is the gross margin. What is the gross margin of my business? What is the net profit margin of my business? What is the return on capital employed? What is the returns that I'm generating from the capital that I've invested in the business? Or I can evaluate my performance based on the basis of the benchmarking, where I compare my performance with the standard industry, with the industry in which I'm operating, with my own past year performances, or with my competitors. I may also evaluate my performance based on the balance scorecard. What are the responsibility centers on which I can evaluate my performance? I can evaluate my performance based on the cost centers, based on the revenue centers, based on the profit centers. Now, let's see an example. A factory manager might be judged on, uh, we can check the performance of the factory manager on achieving the target contribution margin, keeping material wastage below a threshold, meeting production targets, or maintaining the product quality. Like whether is he able to achieve the targets effectively or not, what's the defect rate that the particular factory manager is actually incurring. If the actual figures deviate then the actual budget, then the manager must explain the causes. Like what was the reason for the defect? Is it because the machinery has break down, or is it because of the poor quality of the suppliers? And basis the correct explanation that the factory manager provides to me, I can take the corrective actions for the future so that in future the defect can be eliminated. Now let's move on to one full question, which is the most famous type of questions in your real exam. This question will cover everything: your budgeting, your variance, and your decision techniques. So, ABC let's see what the question is talking about. The question is saying कि ABC Limited manufactures a single product. The standard cost per unit of the product, which we have decided, is that what the requirements of achieving the particular revenue that we are planning. We will require material that is 4 kgs at rupees 2.5 per kg. We will get material for manufacturing 1 unit. We require 4 kgs and 1 kg is available to me at 2.5 per kg. So for manufacturing 1 unit, I will incur an actual expense of rupees 10 in case of material. What are the labor requirements? To manufacture 1 unit, I need at least 2 hours. And the labor that is available with me is at rupees 6 per hour. So what is the total cost of labor that I would have to pay if I manufacture 1 unit is, say, let's say 12 rupees. Now my variable overhead turns out to be rupees 3 per unit, and my fixed overheads, which is also called as my absorption, that turns out to be rupees 5 per unit. What is the production or the budgeted production that I'm actually planning to achieve? I'm planning to achieve, say, 5,000 units. What is my budgeted fixed overheads? So let's say my fixed overheads that I've planned is going to be my 25,000 rupees. Now let's see what are the actual results for the period. Actual results turned out to be that we actually manufactured and sold 5,200 units, whereas we were budgeting to sell 5,000 units. So in this case, we have actually sold additional 200 units. The material that we used was 21,300 kgs. We have used labor for 10,800 hours. We have actually incurred a variable overhead of 16,000. And we have actually incurred a fixed overhead of, say, 24,500, where we were planning that we will be incurring a fixed overhead budget of 25,000. We ended up incurring less, that is 24,500. Now let's calculate different variances. Now let's first calculate the material price variance. What the question is asking me to do, the question is asking me to calculate what material price variance and usage variance, labor rate or labor efficiency variance, variable overhead variance, the fixed overhead variance, and I have to also comment on the results. So now let's start calculating the different variances. So when I budgeted that I will need 4 kgs for manufacturing 1 unit. That means I decided that the material that will be required for me is going to be 20,000 kg in total. But I ended up using 20,800. But I ended up using, how much was the actual? I ended up using 21,300 kgs. But one thing that you need to observe, we decided to sold 5,000 units, but we actually sold 5,200 units. So how much material we would have used in actual? We would have actually used 20,800 kgs. So you can see over here the total standard for 5,200 units, because since I've sold 200 units extra, the actual usage of material should have been 20,800 kgs. But I ended up using 21,300, that is 500 kg extra I have used in case of material. My actual usage cost was 55,750. My actual usage of the material cost was 55,750 rupees. That means where I decided that my actual where I decided that per kg will cost me 2.5 rupees is actually costing me 2.61 rupees. So here also I am paying 0.11 extra. So both my material price variance and my material usage variance will gonna give me an adverse result because I have used extra 500 kgs and I paid extra 0.11 rupees. Now actually see how the calculation is actually happening. Material price variance. We incurred actual 2.61 where we decided to pay only 2.5, which is giving me multiplied by the actual quantity, which is actually giving me 2,510 rupees an adverse effect. So I have paid extra of 2,510 rupees because I paid extra 0.11 per kg. Now let's talk about the material usage variance. Where I would have actually used 20,800, have incurred 21,300. So basis the standard rate, I have used I have wasted 1250 rupees extra because I have used extra 500 quantity, 500 kgs. So 2510 plus 1250, this turns out to be 3,760 rupees extra that I have paid, which in this particular case, because I have used extra 500 kgs of material and I have paid 0.11 rupees extra. Now, let's come down to the labor variance. I said that to manufacture one particular unit, I will need 2 hours. But I will need 2 hours. And how much I've actually produced? I've produced 5,200 units. So the number of hours that would have been required to particular product produce those 5,200 units would have been 10,400. But the number of hours that I've actually incurred was 10,800. That means from this particular prima facie, we can say that we have used 400 hours extra. Since I've used 400 hours extra, this is going to give me an adverse result. This is going to eat up with my profit. I have for 10,800 hours, I have actually paid 64,800, which means the actual rate per hour would be rupees 6. I have decided in the past that I will actually incur a rate of per hour rate of rupees 6. And in actual also, I have paid rupees 6 only. That means there is neither a favorable result for me in terms of labor rate or neither an adverse result for me in terms of labor rate because what I have decided, I have paid that particular rate itself. So my labor rate variance is zero. It's neither adverse or neither favorable. In terms of labor efficiency, we should have done the work in 10,400 hours, but we have actually incurred 10,800 hours. This means I have used extra 400 hours. This 400 hours have given me an additional hit of 2,400 in my profit. So because of using extra 400 hours, my profit is going down by 2,400 rupees. Now let's talk about the variable overhead variance. I decided that my standard overhead variable is going to be rupees 3 per unit. So since I manufactured 5,200 units, my total cost would have been 15,600. But my actual cost turned out to be 16,000. That means I have paid additional 400 in case of variable overhead. So variable overhead is giving me an adverse variance. Now let's talk about the fixed overhead variance. So we decided that the budgeted fixed overheads is going to be 25,000 rupees. Fixed overhead absorption rate, we read in the previous particular topics that the budget fixed overheads we allocate on over the quantity, basically number of units that we are going to produce. We were planning to actually incur overhead of 25,000, over 5,000. So my cost budgeted overhead absorption rate would have been 5 rupees per unit. My absorbed fixed over in that particular case, my overhead would have been around 26,000 because I in planned for 5,000 units. I actually ended up producing 5,200 units. So this would have been 26,000 rupees. But the actual fixed overheads that I've incurred is just 24,500. That means because I have planned for less, I produced more. I am giving 1,000 extra because this 26,000, my actual budgeted overhead, my budgeted overhead was 25. Just because I've given more production, I have given 1,000 rupees extra in case of my budget fixed overheads. So this 1,000 is because I produce more quantity. Now, alternatively, different between this 1,500 is an additional favorable for me. I have, in case of 5,000 units, I would have used a fixed overheads of 25,000. But I ended up producing 26, 5,200 units. Since I've produced more 200 units, those 200 units have given me a favorable of 1,000 rupees profit. Now, this 1,000 rupees profit, when I compare with 24,500, now my comparison is not with 25,000 because 25,000 was 500. I actually produced 20, I actually produced 5,200. So now my comparison of the actual is going to be with 26,000 and not 25,000. So this 26,000 has given me an additional 1,500 rupees profit. Now let's start commenting on the same because the question is also asking me to comment. Let's talk about the material price variance. Material price variance was adverse that we have actually seen because the company has paid more per kg than the standard rate. We will investigate this. We investigated the supply pricing or the bulk discounts or the negotiation so that we can decide for the future that what is the rate that we have to keep for the future this thing. Material usage variance. We found that we used extra material, which has given me an adverse results. When we investigated, we find out the reason of spoilage or there was a theft or inefficiency in the processes. Labor rate variance. Labor rate variance was zero, which was neither a good for me or neither a bad for me. We actually incurred what we had actually planned. Now let's talk about the managed labor efficiency variance. The labor efficiency variance was adverse because we actually used more hours than what was the standard. When we investigated, we identified that it was either because of the inexperienced workers or there was a machine breakdown in between which leads to more number of hours or there was a delay in the processes or due to the absenteeism of the laborers. Now let's talk comment on the variable overheads. So our variable overhead was an adverse variance that they have given. This is because we have rose more than the expected for the level of activities. Then comes the fixed overhead volume variance. We produce more than the budgeted, which gives me fixed cost per unit fall. But one check here is can be because of the capacity we sustain, where the fixed cost was under absorbed. Or now the management should use these variances and all the investigations that have been done to identify and correct all the inefficiencies, renegotiate the price with the suppliers, improve the process so that the labors can be utilized properly. The training should be given to the labor so that whatever the variants that are there in the labors can be corrected, and we can achieve the budget, or we can be in a favorable position in terms of the budgets that we have decided. This was the proper revision that we have done for the management accounting. Now, for the exam purpose point of view, there are some tips for you for your exam preparations or for your revision strategies. You sh- for your exam preparation, you should understand the formulas properly, because these formulas will help you a lot in solving all the questions in your exam time. No, you should know what each of the variants means, how to calculate these variants, what are the interpretations that can be made out of each of the variances in the business terms. You also have to practice as many exam style questions as may be required, specifically the multitask questions, because each question comes for 10 marks, and this 10 marks can be a game changer for you. Also in exam you will feel that mostly examiner loves the comments or the explanation, so try to give comment or the interpret. You should understand how to interpret the results. Once you know what all the variances means, you can easily be able to identify you can easily be able to comment on the result. You will be able to interpret the result. So for ACC exam point of view, you should not just focus on remembering the formulas or remembering the concept. You should try to understand the concept. You should try to interpret the results. Once you understand the concept, you will be able to interpret the results properly. You can use summary or the pocket notes to consolidate your key formulas and the concepts. And in the end, I would say all the very best for you for your paper. Thank you so much.
Thank you, Ashish.
Thank you, Mithun. Mithun, I hope I was able to make you understand what the management accounting is all about in just next 2 hours.
Yes, absolutely.
Uh, then, Mithun, if you need Mithun, I can also forward this particular management accounting and notes with you, so that you can use these particular notes for the benefit of the students, so that they will be able to use it properly.
Yes, that would really help us uploading it on the LMS and for further reference of the students.
So, because yesterday I meet. Can you stop? I'll connect over a call, Mithun, with you.
Sure. Thank you so much.
Then, thank you, Mithun. Thank you.